Devon and Erin, we're here today to talk about investing. There's like over 2,000 unit trusts to choose from. There's a couple of hundred investment service providers out there, which leaves the person who wants to start investing probably feeling a little bit overwhelmed. So I suppose the question is, where do we start? How does a person who wants to invest, how do they start investing?
Great question, Sue. Often when clients come to us, they start the discussion with the product in mind or the fund selection in mind. And where we want to start the conversation is, what is the purpose of your investment? So if we can understand the purpose of your investment, what you're trying to achieve, then we can go into the discussion around what product fits that purpose and what fund selection will fit that purpose.
Erin, just to add on to what you were saying there, the reason why we want to understand the purpose of the investment is because of the human behavioral component. We all know that humans are emotional creatures, and it's important for us as planners to understand what the goal is so we can kind of preempt what behavior we're going to have from our client, and they can understand what they might experience during their journey of achieving their goal.
So you've met with a client, you understand what the client's goals are for their money. There's a lot of different investment products available out there, unit trusts and retirement annuities and all sorts of other vehicles. How do you choose what type of vehicle to invest in, what type of investment product to invest in?
You're right, especially with all these big companies, trying to gain market share by advertising, they're promoting all the different types of investment products. And the important thing is to understand how they work first. So we have retirement annuities, pension funds, provident funds, endowments, discretionary unit trust investments, tax-free savings accounts. So the next step is to actually unpack it to see which one is the most appropriate for your goal.
So if we had to take retirement annuities, for example, it's a great fund to use when your investment goal is providing for an income in retirement. They've got wonderful tax benefits. The contributions that you put in are based on pre-tax income, and the growth and income within the fund are also tax-free. When you get, for example, a tax-free savings account, a lot of people are under the misconception that the contributions are also tax-free. They aren't. So the contributions that you put into a tax-free account, for example, are after tax, and they're limited to 36,000 Rand per annum or 500,000 Rand in a lifetime. So when choosing different products, you've just got to understand the structure of the product and if it's going to fit your goal.
So for example, you have an endowment product, for example, where everyone hears about an endowment and they often ask, should I have one? And it's just about understanding how it works. So for example, an endowment is a great vehicle to use when you need to nominate a beneficiary to help with estate planning. There's certain tax benefits for individuals that have quite a high marginal tax rate, versus maybe just a normal discretionary unit trust investment, where depending on the goal, if it's short term, you might want to go a little bit more defensive, or if it's a longer term, maybe a bit more aggressive. But a discretionary unit trust investment doesn't have certain tax advantages like an endowment, for example.
Sure. So if a client has to come to you today and say, for instance, you advise her that the best vehicle or product for her needs is a unit trust investment portfolio, how do you go about structuring that underlying portfolio? What decisions need to be made? It's obviously not a one-size-fits-all, because every person's timeline, investment horizons, return requirements are different. So how do you go about building that portfolio?
Oh, good question. There's still another step. You can see we're quite education orientated. So we've gone through understanding the goal. We've gone through trying to understand the vehicle. So now we know we want to invest in a discretionary unit trust. The next thing is to understand, what options are available to us? And that's where we come to the phrase asset classes and asset allocation. And the next most important step of the process is to help the client understand how each of those different asset classes work, so we can again align it with that goal that the client has for their investment.
Just to add on to what Devon said, so if we had to put a very basic rule of thumb in place, if you know that you are looking to have a long-term investment that's targeting growth, you want to look at growth assets. So Devon mentioned different asset classes. So typically your growth assets would be something like equities and properties that are going to outpace inflation and grow your capital. Whereas if you were looking to invest in something conservative to preserve your capital, those might not necessarily be appropriate. So you'd want something that's invested in a conservative asset class such as cash.
So just to build on to that, one of the common questions we get from clients is, well, what return can I expect from these different asset classes? You know, is it guaranteed, for example? And this is a big part of the education drive we go on before placing a client in an investment, and that's to get them to understand the risk-reward trade-off between the different asset classes. So, for example, if we take equities as an example, the long-term expected average of this asset class in terms of the return we would expect is inflation plus about 6 to 7. Now that is across the globe, showing 100 years of data. So it's not going to happen every single year, but that's what someone should expect when investing in the long term. Properties is very similar, inflation plus 4 to 5%. So as Erin said, those are the two growth asset classes. That's where you want to grow your wealth above inflation, versus your defensive asset classes, cash and bonds, where it's more of a capital preservation. Yeah. You're looking to protect your capital against inflation, where cash would keep pace with it, and bonds maybe beat inflation by about 1 to 2%. So you can see that the volatility of these different asset classes is important to understand, because this now ties back into the investors' risk appetite and how they're going to react to this volatility. So it's very, very important that we have our clients understand how these different asset classes work and what they should expect in the short, medium and long term before they make that decision.
Okay, but having said that, this is obviously a very highly technical area, and the average person in the street is not an expert on asset allocation and equity markets. So going back to the client who you advise to take out or to invest through a unit trust portfolio, how does that client continue to manage that portfolio, make changes to the underlying assets? Who does that? How does it all work?
Yeah, very, very good question. And the answer is there are quite a few options. So you will have the client on the street who will be quite adverse with what's going on around the world and feel like they can make those decisions themselves. And they can. Through the various unit trust platforms, you can buy, sell different unit trust funds. You can go directly to a stockbroker, invest in your own share portfolio. You will have stockbrokers who will say they'll do it on behalf of you as a client. And you'll have some financial planners who will also tell their clients that they will make the decisions on their behalf to make those changes. The reality is no one knows what's going to happen in the future. And it is a very, very technical skill, like you mentioned. And what we're finding now is that there are businesses out there called discretionary fund managers or portfolio managers. And their role is that they specialize on making these decisions for clients, picking and choosing specialist asset managers to look after the different asset classes around sectors across the globe. But that is a conversation for another day.
And I think what's important, Sue, is you mentioned ongoing management. So, when we talk to our clients, we're quite clear on what we do as financial planners. We are there to help you understand what you're trying to achieve, what your goal is, the appropriate products, and what targeted return you're looking for. But the portfolio manager is there to ensure that there's an ongoing maintenance, so that when things change, the environment changes, legislation changes, they're able to make decisions quite quickly on our behalf, and we get to spend our time with our clients and not necessarily watching what's happening in the market.